Good morning once again. This is a 302 class on accounting. Last week we discussed service costing, but today, by God's grace, we talk about marginal and absorption costing under study session 4. So just permit me to share my screen. Please, I hope you can see my screen. So I want somebody to on his video and wave if you can see my screen clearly, please. Can you see my screen? Oh, thank you. God bless you. So as I was saying, I said this study session for marginal and absorption costing techniques. This is a very important topic in accounting, most especially in cost accounting. So it deals with costs. When we are talking about costs, we're talking about the variable cost, we're talking about the fixed cost, we're talking about the semi-variable costs, we're talking about manufacturing cost, and so on and so forth. So now, only the costs that vary with the decision should be included in decision analysis. What they are saying here is that any costs that are not relevant should be ignored or should be disregarded. Only the relevant cost should be included in any decision that a cost accountant or management accountant want to take. So for many decisions that involves relatively small variation from existing practice and or for a relatively limited period of time, fixed costs are not relevant to the decision. This is because fixed costs tends to be impossible to alter in the short term, or managers are reluctant to alter them in the short term. What they are saying here is that we said only cost that varies with the decision should be what should be included. That is, all the other costs that are not vary with the decision or with the level of output should be ignored or should be disregarded. So now, fixed costs are not vary with level of output. Automatically, they have to be disregarded. Why? Because if you look at the fixed cost, look at this building, for instance, is an example of a fixed cost. This building now do not vary with the level of output. Look at the number of computer systems that are here. So sometimes we might increase the number of systems here, or we might reduce the number of systems here. So the output here does not vary with the building itself. So that is why the cost associated with this building should not be what? Should not be included in our decision, because we might find it difficult to alter the cost of the building in a short term, because it's a long-term process. So now, this now calls for the techniques of absorption costing and marginal costing. So absorption costing is widely used for cost control purpose, whereas marginal costing is used for managerial decision making and control. When we get to the root of this study session, you'll be able to understand what I mean by that. So having said that, we should be able to understand the theory and principle of marginal costing, and we should be able to know the features, advantages, and disadvantages of marginal costing. And then we should be able to define absorption costing and discuss the advantages and disadvantages of absorption costing. And then we should be able to differentiate between marginal costing and absorption costing. And lastly, we should be able to identify the items in a sample format of marginal costing and absorption costing. So I want you to pay attention to this topic. It's very, very important, and you cannot do without them in the exams, because they are very important topics that you need to know. So first and foremost, let's talk about marginal costing. What is marginal costing? Anytime you hear the word marginal costing, what is the first thing that comes to your mind? So marginal costing distinguishes between the fixed and variable costs. Marginal costing distinguishes between the fixed and what? And variable costs. That's the major thing that you need to know as regards what? Marginal costing. Then if you look at a manual, they say the ascertainment of marginal costing is based on the classification of and segregation of cost into fixed and variable cost. That is, when you want to do anything in marginal costing, the first thing that you do is you separate your cost into either fixed or what? Or variable cost. That is the first step. So it is essential to understand the meaning of what? marginal costing. So marginal costing now means the cost of marginal or last unit produced. The cost of what? Marginal or last unit produced. It's also defined as the cost of one more or one less unit produced besides existing level of what? Production. In this connection, a unit may mean a single commodity, a dozen, a gross, or any other measures of what? Of goods. So invariably, what we are trying to say here is that when you are talking about marginal costing, so marginal costs is different from what? Marginal costing. Because marginal costing is a technique. Marginal cost is as if you are talking about variable cost. Marginal cost is also known as what? Variable cost. So when you are talking about marginal cost, the cost of one or more or one less unit produced beside existing level of production is referred to as what? Marginal cost. So while marginal costing can be defined as the accounting system in which variable costs are charged to cost unit and the fixed cost of the period are written off in full against aggregate contribution. What they are saying here is that only the variable cost is what is included in the what? In the decision-making process. The fixed costs are what? Are disregarded. So when you're not talking about marginal cost of a product, it is a variable cost. So you'll be talking about variable cost. So, and this is normally taken to the direct labor, direct material, direct expenses, and the variable part of what? Overheads. So those are the things that constitute marginal cost of a product. So now, we have one example here. If a manufacturing firm produces X units at the cost of 300 naira, and X plus 1 unit at the cost of 320 units, that is, the manufacturing firm increases the unit by 1. The cost of additional units will be what? 320 minus 300. That is 20 naira, which is marginal cost. So marginal cost is just the difference between the extra units produced and the original actual units that are produced. So similarly, if the production of X minus 1 unit comes down to 280, the cost of marginal unit will be what? 20 naira. That is 300 minus 280. So that is what marginal costing is telling us. So now, without wasting much of our time, let's quickly talk about contribution. Contribution. If you look at the word contribution, contribution is synonymous to profit, but they are different. Contribution is like profit, but what? They are different. What makes the difference is just the fixed costs. Just get that. So what makes the difference between the contribution and the profit is what? Just the fixed cost. Then when you're talking about contribution is just the sales revenue minus variable cost. Sales revenue minus variable cost. That is the revenue or the sales that you make. So you now deduct your variable cost from it, you arrive at marginal cost, or you arrive at the contribution. So in essence, what we are saying here is that if you look at the contribution that I'm talking about, immediately you take cognizance of fixed cost into consideration, you arrive at what is first as profit. That is why contribution and profit, they are interwoven. You can use contribution to get your profit, and you can use profit to get your what? To get your contribution. Who is Olusola Emma? Do you want me to remove you? Why are you doing all this? So now, what we are saying here is that contribution is equal to fixed cost plus profit. Here you factor in your fixed cost. So you arrive at what? Profit. That is, fixed cost is equal to contribution less profit. Or you can say profit is equal to contribution less fixed cost. There may be a situation whereby the business neither gain nor loss. That is when the business or the organizations are break even, When the organizations are break even, automatically contribution is also equals to what? Profit. That is no profit. Look at this. Let me show you something. Look at what I'm saying here. We have C for contribution, which is equal to fixed cost plus profits. So automatically here we have P, which is our profits, to be equals to 0, because the business does not making any profit nor loss. So it's a break even. When the organizations are break even, at least, they neither make profit nor what, nor loss. So when we have 0 here, automatically our contribution is equal to what? Our fixed cost. Do you understand? There are some situations whereby you have your contribution minus fixed cost to be equals to what? To be equals to profits. So some situation we might have our contribution to be equals to profit plus fixed costs. So it depends. So whatever you are asked to do, so you can do the change of subject or formula to arrive at it. So now, what are the theories of marginal costing? The theories of marginal costing. That's the next line of action. The theory of marginal costing. So in relation to a given volume of output, additional output can normally be obtained at less than proportional cost, because within limits, the aggregate of certain item of cost will tend to remain fixed, and only the aggregate of the remainder will tend to rise proportionately with increase in output. Conversely, a decrease in the volume of output will normally be accompanied by less than proportional fall in the aggregate cost. What they are saying here is this: our variable cost, variable output graph, or let me just say marginal cost graph. We have as output increases, the cost will also be increasing. As output decreases, the cost will also be what? Decreases. So that is what the theory is talking about. So, and the theory gives us two major steps here. If the volume of the output increases, the cost per unit in normal circumstances reduces. Conversely, if an output reduces, the cost per unit increases. If a factory produces 1,000 units of a total cost of 3,000, and if by increasing the output by 1 unit, the cost goes up to 3,002. You can see that here, the output of 1,000 units gives a total of what? 3,000. By increasing the output by 1 unit, the cost also increases by what? By 2. By additional output will be increased by what? 2 naira. And if an increase in output is more than 1, the total increase in cost divided by the total increase in output will give the average marginal cost per unit. So what they are saying here is that if the output of a factory is increased to 10,020 units from 1,000, that is, it has increased by 20 more additional units. And the total cost to produce this unit is 1,045. The average marginal cost per unit is just 2 naira 25 kobo. That is the difference in cost divided by the difference in what? Units. So that is, if you look at the cost, we have the first cost that we have is 1,045, and we have 1,000 naira before. So the difference in cost is 45, and the difference in unit is what? Is 20. So we have 2 naira 20 kobo. So the principles of marginal costing. The principle of marginal costing are as follows: for any given period of time, fixed cost will be the same for any volume of sales and production. Look at this thing now. This building was built maybe last 4 or 5 years. Do you understand? And they have been increasing the number of computer outlets here almost every year. So the number of output does not commensurate with the building itself. So whatever the level of output, the building still remain the same, which is the cost of the building. So therefore, selling an extra item of product or service, the following will happen. the following will happen. So now, the first one, revenue will increase by sales value of the item sold. Cost will increase by the variable cost per unit. Profit will increase by the amount of contribution earned from the extra item. The first thing is the sales will increase by sales value of the item sold. Cost will increase by the variable cost per unit, and profit will increase by the amount of contribution earned from extra units. So those are the principles that we need to understand. So then, similarly, if the volume of sales falls by one item, the profit will fall by the amount of contribution earned from the item. That is why you cannot separate contribution from profit. So profit measurement should therefore be based on an analysis of total contribution. Since fixed cost lasts to a period of time and do not change with increase or decreases in sales volume, it is now misleading to charge unit of sales with a share of fixed costs. Because you can only get your profit once the fixed cost has been involved. Do you understand? So when a unit of product is made, the extra cost incurred in its manufacture are the variable production cost. Fixed costs are unaffected, and no extra fixed costs are incurred when output is increasing. That is, fixed costs remain the same no matter the level of outputs. So what are the classification of marginal costing? Or let me just say, what are the features of marginal costing? So the main features of marginal costing are as follows. We have cost classification, we have stock valuation, and we have marginal contribution. When we are talking about cost classification, you know, in the first, when we started the lecture, I said the cost can either be categorized into fixed or variable costs. So the classification, there should be a sharp distinction between the variable cost and the fixed cost. So once you're able to distinguish between your fixed cost and variable, it will be very easy to calculate your marginal cost. It is the variable cost on the basis of which production and sales policies are designed by a firm following the marginal costing techniques. So we have stock valuation, or what is referred to as inventory valuation. Inventory valuation or stock valuation is for profit measurement, and this is valued at marginal cost. You know, maybe in your theory level, when we are talking about inventory, we said the inventory is strictly discussed under IS2. Do you understand? And we have some measurements. So inventory can be measured at lower of cost or neutralizable value. Do you understand? The one that is lower, either of the two. So this lower of costs and neutralizable value that we are talking about should be at marginal cost. It is in sharp contrast to the total unit cost under absorption costing method. You know, when we get to absorption costing method, absorption costing method encapsulates the total cost involved in the production process. So that's the main difference between absorption costing and marginal cost. Marginal cost only focused on variable cost of production. So any costs that are not varies with the level of output should be ignored or should be disregarded. So the third one is marginal contribution. Marginal costing techniques makes use of marginal contribution for making various decisions. Marginal contribution is different between the sales and marginal cost. It forms the basis for judging the probability of different products or departments. So those are the features of marginal costing. So let us look at the advantages and disadvantages of marginal costing. When we are talking about advantages of marginal costing, so we can say that the first one is it is very, very easy to understand. Marginal costing is very, very easy to understand. To me, or let me just say, if I want to explain marginal costing to a layman, what I'll just say is, okay, what is marginal cost? Do you understand? Is the cost that is associated with the extra units produced. Do you understand? So now, what is marginal costing techniques? Do you understand? So if you look at the marginal costing techniques, what the technique is telling us is that you have to separate your cost into either fixed or variable cost. You know, it is very easy to understand. Oh, okay, all these items now. So which one is fixed? Which one is variable? So once you're able to get that, So it will be very easy for you to calculate. So by not charging fixed overhead to cost of production, we said fixed overhead is not what? Is not relevant to our decision making. That is why it has to be what? Disregarded. So fixed overhead is not relevant to our decision. Only variable cost is what is relevant. So the effect of varying charges per unit is avoided. You'll not be able to vary any charges or doing anything because it has no effect on our production. So it prevents the illogical carry forward in stock valuation of some proportion of current year's fixed overhead. When you say measurement of stock valuation, we said it has to be with what? With marginal costing. So the effect of alternative sales or production policies can be more readily available and accessed, and decision taking will yield the maximum returns to business. So it also eliminates large balances left in overhead control account, which indicate the difficulty of ascertaining an accurate overhead recovery rate. So practical cost control is greatly facilitated through marginal costing. That is by avoiding arbitrary allocation of fixed overhead. Effort can be considered on maintaining a uniform and consistent marginal cost. It is useful to various levels of management. Last but not the least, it helps in short-term profit planning, break-even. Since we have excluded the fixed cost, which talks about the long-term effects. So marginal costing is also used in short-term profit planning. So for every advantage, there must be a disadvantage. So these are the advantages of marginal costing. One, separation, we said separation of cost into fixed or variable cost. Do you understand? Most times it might be difficult for you to know that this item is for fixed and this item is for variable. Do you understand? And sometimes gives misleading results because if you cannot accurately segregate your cost into fixed or either cost, the result might be what? Might be misleading. So normal costing systems also apply overhead under normal operating volume. And this shows that no advantage is gained by marginal costing. Under marginal costing, stocks and work in progress are understated. So that's another thing. So the exclusion of fixed costs from inventory affects profit, and true unfair view of financial affairs of an organization may not be clearly transparent. Because if the exclusion of fixed costs from inventory affects profit, automatically it might be difficult for you to have a true and fair view of the financial affairs. So then the next line of disadvantage is volume variance in standard costing also discloses the effect of fluctuating profits, fluctuating outputs on fixed overhead. Marginal costs that have become unrealistic in case of highly fluctuating levels of production, such as the case of seasonal factories. So those factories that engage in seasonal products might experience this kind of disadvantage. Application of fixed overhead depends on estimate and not on the actuals, and as such, there may be under or over absorption of the same. So this is a peculiar feature of absorption costing. Then control affected by means of budgetary control is also accepted by many. In order to know the profit, to know the net profit, we should not be satisfied with contribution, and hence fixed overhead is also a valuable item because we have incremental fixed costs here. So if we have incremental fixed cost is what is relevant to the decision making. So when we get to the root of this topic, you should be able to understand what I mean by incremental fixed cost, because incremental fixed cost varies with the level of output. Although they are fixed, but they are varied with the level of output. In practice, sales price, fixed costs, and variable cost per unit may vary. Thus, the assumption underlying the theory of marginal costing sometimes becomes unrealistic. So those are the disadvantages of what marginal costing. So I said something the other time. I said this particular topic or session talks about marginal costing and absorption costing. So now the next thing that we need to discuss is absorption costing. What is absorption costing? What exactly do we need in absorption costing? Do you understand? So absorption costing is the method of accounting for costs, which entails the full cost of manufacturing or providing a service. when we are talking about marginal costing the other time, I said only the variable that are relevant to decision making should be included. We don't need to include the fixed costs to our decision making. So automatically, once the fixed cost has been excluded and we concentrate only on marginal costing, what we are doing is what? We are doing marginal costing. But when we now try to incorporate both the fixed or the cost actually with the level of output, so automatically we are talking about what? Absorption costing. So absorption costing includes not just the cost of materials and labor, but also all manufacturing overheads. So that is why the cost of each cost center can be either direct or indirect. In another sense, when you are talking about absorption costing, so it might refer to a method of costing to account for all the cost of manufacturing. So management sometimes they use absorption costing to absorb the costs that are incurred on a particular product. The cost might include direct costs and indirect costs. We have direct costs, which include direct labor used in production, and we have indirect costs, which might include the factory rent, administration costs, compliance costs, and insurance costs. So the costs observed under absorption costing might include variable costs, fixed costs, and semi-variable costs, which is invariant with the cost that we have in marginal costing. So in short, I can say that absorption costing is also known as full costing. What I say, full costing. So absorption costing is also known as full costing. Do you understand? So why is it the full costing? Why is it the full costing? So now, I'm sorry for the interruptions. So what I'm saying is this absorption costing is regarded as what? Full cost. So now, what are the advantages and disadvantages of absorption costing? The major advantage of absorption costing include the following. Absorption costing include an element of fixed overhead in inventory values. Include an element of what? Fixed overhead in inventory values. Absorption costing analyzes under and over absorption. That's a major thing in absorption costing. Under absorption and over absorption. And this is a useful exercise in controlling cost of an organization. They use this to control what? Cost. That is the method of what? Cost control. In small organization, absorbing overhead into the cost of product is the best way of estimating job cost and profit center. So the disadvantages of absorption costing. One, fixed overhead are difficult to accurately attribute to each unit, hence result are spurious. When you say spurious results, that is misleading results. That is not genuinely dependent on the various allocation methods used. You might have misleading results. Then two, absorption costing is dependent on the level of output, which may vary from period to period, and consequently, cost per unit changes due to existence of what? Fixed overhead. In absorption costing now, fixed overhead is what is included. So marginal costing versus absorption costing. So the two techniques I've said so many things about them. To know the differences might not be a problem. The fixed overhead are period cost and are charged in full to a period under consideration. You can see fixed overhead can never be absorbed exactly because of difficulty in the forecasting cost and volume of output. Work in progress and finished stocks are valued at marginal cost. So work in progress and finished stock are valued at total production cost because it involves all the costs. Stocks are valued at variable production cost only. Items of stocks are costed to include a fair value share of fixed production overhead under absorption costing. Then under marginal costing, unit variable costs are unaffected by the volume of production. Under absorption costing, absorbed unit costs are reduced by production in greater quantity. So then under marginal costing, it is easy to operate. While absorption costing is always difficult to operate because of its complexity. So under marginal costing, marginal costing is used for decision making because only costs that are vary with the level of output should be included in our decision making process. But under absorption costing, it does not provide any useful information for decision making because of the inclusion of what fixed costs. It's also known as direct or variable cost. Why the absorption costing is also known as what total cost or full cost. So those are the differences between the absorption costing and marginal costing. Presentation of cost data under marginal costing and absorption costing. How do you present your data? So marginal costing is not a method of costing. It's just a technique of presentation of sales and cost data with a view to guide management in making a decision. That's why we said we included only the relevant cost of production. So the traditional techniques, popularly known as total cost, absorption costing techniques, does not make any difference between variable and fixed cost in calculation of profit. Those two costs are included. But marginal cost technique very clearly indicate the difference in arriving at the net operational result of a firm because you have to segregate. That is the first thing you do in marginal costing. You have to segregate your marginal cost and your variable cost from the fixed cost. So this is the format for marginal costing. You have the sales revenue, then your marginal cost of sales, opening stock at marginal cost, you add production cost, value at marginal cost, you get the total production. So then you less closing stock. When you less closing stock, all your stock, they are valued at what? Marginal costing. But when you get to absorption costing, it will be different. So marginal cost of production. So once you arrive at marginal cost of production, you add selling and distribution expenses. So you arrive at marginal cost of sales. So sales revenue minus marginal cost of sales will give us contribution. Don't forget in our definition of contribution, we say sales revenue minus marginal cost of sales. So we have contribution. So contribution, then don't forget that the fixed has to be what? Excluded. So you now remove your fixed cost from your what? From your contribution. Contribution less fixed cost will now give us what? Profit. So that is why I said most times when you want to get your profit, you have to ensure that your fixed cost is excluded from your what? From contribution. So that's the format for marginal costing. Then we have format for absorption costing. So we have sales revenue, absorption cost of sales. So you look at this format, it's the same way, but the only thing is one is value at marginal cost and the other one is value at what? Absorption cost. So then when you get your profits, we have fixed production overhead, we have fixed production overhead absorbed and then incurred. So the two must be what? Differentiated. Once the two are differentiated, automatically you might have either under absorption if it is absorbed, if it is less absorbed, then we have over absorption. So before you can now adjust for your what? Adjust for your profit. So reconciliation statements for marginal cost and absorption cost and profit. So this is once you get your marginal cost and profit, then you now add the difference between the closing and your opening stock multiplied by your over absorption rate. So to arrive at what? Absorption costing profit. So and over absorption rate is the ratio of the budgeted fixed production overhead to the budgeted level of what? Activities. So that is that. If stocks level are rising, that is, if stock level are increasing, so your absorption profit is always greater than your what? Marginal profit. But if stocks level are falling, are decreasing, your absorption profit is always less than what? Your marginal profit. If opening and closing stock level are the same, absorption profit is equal to marginal profit. So those are the things that you need to know. So we have comes to the end of this study session. So whereby we said marginal cost is the cost of one or more or one less unit produced besides existing level of production. And we made mention of the definition of marginal costing, that is an accounting system which variable costs are charged to cost unit, and the fixed cost of the period are written off in full against the aggregator contribution. Then we talk about the marginal costing techniques, which has given birth to a very useful concept of contribution. And we say contribution is different between the sales revenue and what? And the marginal cost. Then we also said the contribution can also be said to be the sum of fixed costs and profits. So where if you do the change of subject or formula, you might be asked to find the fixed cost, you might be asked to find the profit. So break-even point, I say break-even is the point at which the organization is neither gain or loss. So automatically at break-even, your contribution is always equal to what? Your fixed cost. That is the point where profit is what? Zero. So then we finally talk about the absorption cost, which includes the fixed and variable costs, which are ultimately charged or allocated to cost unit and total overheads are then absorbed according to a given level of what? Activities. So that is that about the marginal and absorption costing. So if there's any questions, reactions, or comments, so you are free to do so before we end today's class. So you can unmute yourself. If you have any questions, so you don't have any question. So in the absence of that, I think.
Hello, sir. Hello, sir.
Hello. Okay, Christy Okolo. I'm listening.
Good morning, sir. Okay, sir.
Good morning.
Please, sir, the question I have is, sorry to take you back, because for the last lecture we had on Saturday on the assignment you gave us.
You requested for what?
I said, I want to take you back. The question I have is for the assignment you gave us.
Okay.
Okay, it's on
I'm
question
listening.
1. Okay, it's on question 1.
Okay.
Second question, there's a case that said the distance between A to B and B to C and C to A are 80 kilometers. Then you say A 20 kilometers. I don't understand. There is an A 20 kilometers.
Can you share the question?
Share it. Oh dear. I'm reading it from my laptop. I mean the question 1. Should I go through it again?
I know, don't worry. Let me check it here and I will share it so everybody will be on the same page. Okay. I've seen it for me. Okay. What is not clear there?
It's A 20 kilometers. Is it A 20 kilometers?
Oh, okay. From A to B, you understand, is 80 kilometers.
Yeah.
From B to C is 20 kilometers, not 8. 8 is a typographic error.
Okay.
Then
Thank
C
you.
to A is 160.
Thank you.
You're welcome. So, any other question? In the absence of questions, so I think you can call it a day. Take good care of yourself. Don't forget to do your assignment before the due dates. I'm not going to extend it again because I'm going to give you another one, maybe today or tomorrow, by God's grace. So take good care of yourself. Bye-bye.
Bye, sir. Thank you, sir.
Thank you, sir. Thank you, sir.
Bye.